Empowerment Conference Series here at Turner Chapel. And we have 4 panelists who are here today to share their knowledge with us. And I'll just give you their names and then let them introduce themselves in just a moment. So to my right, we have Natalie Reed. Then we have Dawn Murian, Anitra Walker, and Chris Woods. Those of you in the virtual audience, you'll probably see them momentarily. So with that, let me open us up with prayer. Most gracious God, we thank you for another day. We thank you for all of your blessings. We thank you for those who are here today, those who are tuning in, and those who will watch this at a later time. We just ask, Lord, that everything that we discuss today will pour into your people, and we thank those who are sharing their knowledge with us and ask that you will pour back into them. We ask that everything that we do be pleasing in your sight. In Jesus' name we pray. Amen. All right, so with that, I will turn it over to our panelists, and they can introduce themselves one by one, and then we'll get into some questions. So, Natalie, you can start.
Good morning. Can everybody hear me? I'm Natalie Reed. I'm a State Farm agent here in Marietta, Georgia. I've been an agent. September 1st will be 10 years. We will be relocating closer to the square in about a couple of months, so we'll be your downtown Marietta Square agent. We specialize in auto insurance, homeowners insurance, life insurance, business insurance. We happen to be top 100 in the country for business insurance the last 2 years with State Farm. And we also do supplemental health insurance as well.
Good morning, good morning. My name is Dawn Moraine. I am a real estate agent here in the Metro Atlanta area. My specialty is helping first-time home buyers, single mothers, and people that's relocating to Atlanta. Most of my clientele, I'm based in Henry County, but I do travel the Metro Atlanta area all the way out here to Marietta. So I'm here to answer any real estate questions that you have about buying or selling.
Good morning, everyone. My name is Anitra Walker, and I'm an estate planning attorney. I provide peace of mind to individuals and families with minor children by creating comprehensive will and trust-based plans. And just a little bit about myself, this is so personal to me. In 2013, my grandfather passed away unexpectedly. He was the matriarch of our family, but what he did leave was a gift to our family. Prior to his passing, some years, he went and had his will done. He had his burial instructions completed, and he even told my grandmother what he wanted to be buried in, and this was years prior. So once he left, all we were left to do was grieve. There was no fighting. It was just a celebration. And I got into this area because I feel like if my family can do it, everyone's family can do it. And so I look forward to answering any questions that you have about estate planning.
My name's Chris Woods. I'm a financial advisor. I've been a financial advisor for 24 years. I work with Primerica Financial Services. I'm a regional vice president. I have an office in Smyrna. I work with investments, retirement planning, insurance, and I also am a loan originator for mortgages.
All right. One thing I did forget to mention, for those of you who are here, there is a notes page in the back of the room if you want to take some notes down. There's also a QR code there that will give you bio information on each of our panelists. And for those of you who are online, the virtual moderators are going to put the link to that in the chat so you can see their information as well. Now, what we're going to start out with, we actually had several questions that were submitted from the registrants, so we're going to tackle some of those questions first. And we'll start with a question for Anitra on estate planning. Excuse me. Can you discuss revocable and irrevocable trusts and other ways of protecting your assets, including how to create those?
revocable living trust and there's the irrevocable trust. With the revocable living trust, that's the most flexible type of trust that you can have because you can make changes to it if you want. So by changes, I mean you can place property in the trust, you can take property out of the trust, you can make changes as to who will be in charge of implementing the trust when you pass away, so that's going to be your trustees. If you fall out with your children, you can change the beneficiaries of the trust. Lots of flexibility. You don't have to have any separate tax filing in order to have a revocable living trust. An irrevocable trust is another planning type. You cannot change it. It's a set it and forget it. Generally, for those who are interested in an irrevocable trust, I advise in this direction if one of two situations are occurring. The first is if you find yourself passing away, transferring over $13.6 million. If that is you, we need to look into an irrevocable trust. And when I'm talking about $13.6 million, I'm talking about your worth. So that's everything. That's the value of your house. That's any life insurance, all added up. If it's more than $13.6 million, we need to look at an irrevocable trust because we've got to get some of those assets out of your name into the trust name, and that would be an irrevocable trust. If not, and you're transferring over $13.6 million, someone's gonna have to pay taxes on that, and they're high. The other time that I suggest an irrevocable trust is if your occupation is one where you may be sued a lot. So we're talking about a surgeon, plastic surgeon to be exact. If you have a type of occupation where you may be sued, we want to make sure that we get assets out of your name into an irrevocable trust. So those would be the two times.
Great, thank you very much. And that actually brings up another question that came up, so I'll kind of weave this into that question. You mentioned the $13.6 million. That is the estate tax exemption for anybody who's familiar with that. But that brings up the question with the new tax laws that will be coming into place with the bill that was recently passed, and this is for anybody. How do you see these new tax laws influencing wealth management strategies? And I will say this, because I know for my profession, we have to always disclose we are not tax professionals. We do not dispense tax advice, so I would assume the same is probably true for everyone up here, but we can speak to the issues in a general sense.
I'll just speak. So because we passed this bill and we have a conservative administration, the tax exemption amount is the amount that you are allowed to give to someone else at your passing without being taxed, and that amount is $13.6 million. So with this new administration, because it's conservative, that amount is only going to increase. Okay, it's only going to increase. So some of this is a kind of a wait and see to see what happens, but I'm thinking just because of the conservative administration, it will increase. Well, I'm talking about the federal estate tax exemption amount. So think of it as if you pass away and the value of your assets are more than $13.6 million, the people that you pass it away to will have to pay taxes on whatever that overage is, regardless of whether you have a revocable living trust or irrevocable. But you're right, if you find yourself in that valued amount of assets, you do need to look at irrevocable, at least an irrevocable, potentially with a revocable.
All right, very good. Want to ask a question on real estate that came in for Dawn, and I believe this is more related to commercial, I would imagine. The question is, should real estate properties be in an LLC for tax purposes?
Again, I'm not a tax person as well. I can't answer that question, but for the commercial, I deal mostly with residential, so that wouldn't be in my expertise. But I see a lot of people going that route, putting stuff in their LLC versus it'll be a personal choice whether they want to do it to their LLC or not. I mean, they will have to probably talk to their tax person and ask, is it better to do it either way? I would say that. Go ahead, baby.
Pardon me, if you can go to the mic over here for any questions from the audience, that way everybody in here can hear you as well as the virtual audience.
It, it is. It is advisable to do that because when you're thinking about a trust, it's nothing but a huge instruction manual. So it's going to be a manual regarding your personal affairs and your assets and also your business. So the trust could indicate what happens to the business. So if you're out here and you have a business, you should be thinking about business succession. What happens when I can't do this business or I don't want to do it anymore? Who's going to take over? Is that my children? Is that someone else that's working for the business that has showed the loyalty and dedication to it? So those are things that we want to think about, and placing the business in the trust allows for those instructions to be spelled out.
Okay, thank you very much. Question for Natalie on life insurance specifically. So obviously we're talking about the value of your estate. Life insurance can be a big portion of your estate if you choose to use it for that purpose. Can you explain to us where term life is appropriate versus where permanent life is appropriate, and what are kind of the reasons for one versus the other?
Thank you. So both, I want to state that both are good choices. I don't think one is any better than the other. Term insurance is going to be the most cost-effective way in terms of getting life insurance. And I would say that term insurance is going to cover what you call temporary needs. So and then permanent insurance is going to be permanent needs, long-term. It also builds cash value. So when we're doing a life insurance analysis, we look at life, any loans that you would like paid off upon passing away, income replacement. Those are also going to be temporary things, final expenses, and then educational expenses if you have young children that you want to make sure go to college. We typically take that total amount, and that's what we come up with how much you need in life insurance. And that need could change every year. So just like going to a doctor's appointment to do an annual exam, you need to be looking at your life insurance need on at least on an annual basis, or if you have any major life changes. The beauty about, like I said, term, and with State Farm, we have 3 different types, actually. We have term insurance that goes for the 30 years. We have return of premium, which is a term policy that if you outlive the policy, you get all of your money back, dollar for dollar that you paid. And then we have permanent life insurance. And most people take to that because it's an opportunity for them to, like I said, not just have life insurance, but you also have a cash value component that is growing tax-free that most people typically borrow from. So for whatever reason, they are purchasing a home, they borrow from their permanent life insurance. They are starting a business, or they are, in this case, I know some people have used their permanent life insurance policies as collaterals for taking out mortgage loans as well. And then also some people use it for tax-free retirement. So if you happen to, just say you retire and at that point the market is down and you don't want to sell and take that loss, some people use their permanent life insurance as a backup to kind of, ride that wave. So it is either, I just tell people, at the end of the day, when you pass away, your family is not coming to ask me what kind of life insurance you have. They want to know how much did you leave me, right? Can I pay this mortgage off? Can I send my kids to school? Can I grieve without worrying about bills? But the permanent life insurance, like I said, has a death and a living benefit, and that's more so for the person who owns the policy, for them to take advantage of as well. But at the end of the day, none is bad. I'd rather you have life insurance than not.
Just to piggyback on that just a little bit, we talked about permanent, and people probably are most familiar with whole life insurance. Can you speak to the different types of permanent life insurance policies and differences between them?
So we have, State Farm offers whole life insurance and universal life insurance. I would say the universal life insurance offers a little bit more flexibility than the whole life. But some of our whole life policies we have where you can actually pay them off in either over 10 years, 15 years, or 20 years. So I'll have a whole life policy that it's 10 years old. My last payment will be made in December of 2025, which I cannot wait. So that's one bill that I won't have. It's basically like paying off a mortgage, but that cash value and that death benefit will continue to grow until I'm an old woman, God's willing. Universal life is more flexible, where some people, you can do cash, they call it cash sum, so you can put money into the policy to earn interest. Interest, sometimes the interest is higher than what you would earn in a traditional savings account. But again, both are good because that cash value is run tax-free. Unlike if you had a CD or you had a savings account, whether you utilize that interest that you earn, you are still getting a 1099. Unlike the permanent life insurance, you're not getting a 1099, and you have use for that. You can use that money for whatever you want. There is also out there indexed universal life policy. That's all over social media and all of that. But we don't offer that. And then there's also a variable universal life policy as well that we offer through another company that State Farm partners with. But I'm a little biased. I love the permanent life policies that you can pay off, because once you're done, you're done. So, and then you still have, the benefits of the policy.
Do you want to add anything, Chris, to that? Okay, very good. So I'm coming to you now with a question. For someone who has a very low risk tolerance, what are some good options for them to build wealth?
There's all sorts of ways that someone can build wealth. Mutual funds, I think, offer the best way for someone to build wealth over time. Most people who work, have 401k plans, have access to mutual funds. And mutual funds come in a lot of different shapes and sizes. Some of them are conservative, some of them are aggressive. I say in a lot of 401k plans, you probably have what's called a target date retirement fund. And for someone who wants the management to be sort of outside of them, they don't want to have to pick their funds, and they want it to get safer and more conservative the older they get, I think target date funds are a great choice, as far as investing. Truthfully, if you are concerned about market volatility, what you really want is an advisor. I just prop myself, because a lot of people, fear comes from not knowing and not understanding. That's where fear comes from. I think if you look at market performance over 30 years, 40 years, 50 years, it's not nearly as scary than if you're watching the financial news every day and they try to, fear you into watching it tomorrow, but mutual funds would be my short answer. For long-term investing. For short-term investing, you've got CDs, money market accounts, high-yield savings accounts are ways to go. But understand that you'll never get the rate of return in those sorts of accounts to accumulate real wealth for retirement. Those are typically best suited for emergency funds. Okay.
Good answer. Thank you. Just following up on that a little bit, since you mentioned 401k specifically, someone asked the question, how do I get started investing in stocks outside of my 401k plan? And to do that, how can I set up my own account personally?
Well, thanks to technology, this is something that's really easy to do. And I say that it's a double-edged sword. Yes, you can go online and you can use things like Robinhood or Schwab or Fidelity. Pretty much all of your major brokerage firms now have online tools that you can go in, use yourself, and buy stocks yourself. My caveat to that is, if you don't really know what you're doing, you could make money, but you could also lose money. And that's the trade-off when it comes to investing, particularly when you're investing in individual companies and individual stocks, especially the stocks that everybody wants to invest in, the hot stocks, right? You hear somebody say how much money they made in let's say, this company, and you're like, oh, I want a piece of that, right? Now, one, you have to believe that person's telling you the truth, that they made all the money in the company, which, People sometimes exaggerate, right? And two, if they did, you may be late to the game. You may be buying too late, and when you go in, the value of that company might drop because it was hot and then it was not, you know? So going out and investing in individual stocks, you know, as an advisor is not something that I do for clients. We diversify, and that is a key word. You want to be sure that your portfolio is diversified, meaning owning multiple stocks, having your wealth spread over many, many companies instead of just singular companies that you read online people were getting rich from, you know. But if you want to play with some money, you know, hey, listen, I mean, it's fun. You know, trading is fun. And there's all sorts. I can't recommend one, but there are all sorts of companies that you can go online and get apps where you can buy stocks.
And I think maybe the thing to take away is do your research if that's what you're going to do. Don't just go in blindly, and I think to the point you're making, don't put in money that you can't afford to lose. I understand from the audience that the QR code that we sent is not working. We will send a follow-up email with information to access each of our panelists' bios, so be on the lookout for that post-workshop. If anyone in the audience has questions, please just go to the mic and we'll let you ask your question. I understand also that the virtual audience is having a hard time hearing from that mic, so if anyone asks a question from the audience, please repeat the question in your answer, if you would. And, okay, I think we have someone coming to the mic now.
I'm hearing from different investors about not paying off your home. I mean, some say you should and some say you don't. So I guess it depends on that personal goal. Is that?
Are you talking paying off your mortgage? Is that what you mean
Yes.
specifically?
Paying off your mortgage.
Okay, so the question was, you want me to repeat the question, is it always good to pay off your mortgage? You know, it's really a math question when it comes down to it. You know, depending on what your interest rate is on your mortgage, you know, there's still a lot of people in this country that are sitting on very low interest rates on their mortgage, you know, 3%, 4% rate of return on your mortgage. And the real question boils down to, well, if you don't pay off your mortgage, what are you doing with the money that you would have used to pay off the mortgage? Does that make sense? So let's say I have $100,000 left on my mortgage and I have the good fortune of having $100,000 sitting in the bank. The question being, should I take the $100,000 and pay off my mortgage versus the bank? Well, if my bank yield is 0.25 and I'm spending 3-4% on the interest on the mortgage that I have, well, then it's just a math equation. But as an advisor, I could say, well, yeah, but you could take that money and you could invest it. And over the next 20 years, average 8 to 10% investing in a low-cost index fund and not pay off your home. And that would be a far greater long-term financial decision versus the money you might have saved by paying it off. You know, I talk to clients that are near retirement many times, and they're getting close to paying off their loan, and they have retirement funds, and I get this question quite often, and I always say, well, with a paid-off home, can you eat it? You can't eat a home. And in retirement, what you need more than a paid-off home is you need money and you need income. Does that make sense? So, you know, you have to sort of balance these things out. Now, another question might be not a home, but I have this high-interest credit card, or I have this high-interest student loan. Well, that's another story. You know, getting out of debt is a key part of financial security. But a mortgage in particular, because the rates are so low, that should be the last debt. And really, you should consider, what else could I do with the money if I didn't pay off the home?
Yeah, very good answer. I'll just tack on to that from experience as well. Something that you want to think about is, particularly with real estate, unlike a lot of other things where your money may be housed, it tends to increase in value over the years. So even if you're not paying off your mortgage, the chances are that you're still building equity anyway, meaning your actual net worth is growing. And I think to the point you're making with flexibility, if you have the money available to pay it off, great. But you don't have to pull the trigger just because you have it available. But if there's ever a point where it needs to be paid off, then you can do it. Go ahead, ma'am.
Hi, good morning. This question is for the estate planner. So if you just have like a house and insurance policies, right, with beneficiaries that pay, is there any advantage to having a trust if you just, feel like, I have my house, my house is gonna go to my spouse or whatever, when I pass away, and my insurance policies have beneficiaries. Is there an advantage to having a trust?
Okay, so I'm going to repeat the question. The question is, if you have a house and life insurance with designated beneficiaries, what's the benefit of having a trust? Is that the question? Okay. All right, so I love this question, by the way. So a trust, the benefit of trust is probate avoidance. So probate is the process that your loved ones are going to have to go through. It's a court process. So in Cobb County, it would be the Cobb County Probate Court, where your loved one is going to have to go, and it's a court process. So they're going to have to petition the court, get the authority to carry out your will, or if you don't have a will, to carry out your affairs. Probate is a public process. It can sometimes be costly depending upon whether you've left instructions for your loved ones or not, and it also depends upon your family dynamic. So I'll say this, the benefit of having a trust is that it allows for privacy, because it's not a public type of arrangement, and it also avoids probate, and with a trust, you can leave very specific instructions for your house. So if you're sitting here today and you have a house in your name, or maybe you own it jointly with your spouse, just having that house is not going to avoid probate. In fact, if you own that property with your spouse and there's no right of survivorship on that, you each own 50%. So when your spouse passes away, of course, you'll maintain your 50%. But if your spouse doesn't have any planning, then their 50% will have to go through probate. Going through probate is a hassle. When you go through probate, creditors can step up and file claims against the decedent, the person who passed away estate, and you have to settle it. So if you can, you want to avoid probate. A trust is not always the only way to do it. It's not. We have something now called a transfer on death deed, which I use in limited situations, but it does allow you to transfer your house to whoever you'd want. It could be your spouse if he or she's not on it, or your children, okay? There are certain requirements to it. The transfer on death deed, so if the house is in your name, you're going to be the listed grantor. The grantee is who you decide to be your beneficiaries. It could be your spouse, your kids. Again, you don't want to put too many people as the beneficiaries, because 25 people owning a house is not helpful for anybody, okay? The only requirement for a transfer on death deed, it gets filed while you're living. Once you pass away, the grantees only have 9 months from the date of your passing to file an affidavit to claim the house. If they fail to do that, the house does have to go through probate, which is no fun. So I guess in short answer, you avoid probate, it's private, and you do have a transfer on death deed as an option too, but yeah. Yes.
And and that's for property, yeah, completely no-brainer, but also financial assets, something that we need to be very sure about is if you have a 401k plan at work, you need to be sure that your beneficiaries are on there, right? If you have IRAs, you need beneficiaries on there. If you have bank accounts, you can do a transfer on death with your bank accounts, just your individual bank accounts. Makes life so much easier when that happens. It's just critically important. And I can't tell you how many people I talk to, they haven't updated. Maybe they had a relationship change, a marriage change, and they have their ex as a beneficiary on the 401k plan. Can you imagine? You know, I mean, really? But in the financial companies, they just go with what's written down. But if you do not have a beneficiary and then it defaults to your estate, then that means all of those funds, all of that money also has to go through probate, and spouses and children and everybody else get to petition for their rights to whatever amounts there is. So having named beneficiaries, having a will, very important.
Great.
One last thing. That is so important what he said. And I have seen these type of assets, life insurance policies, retirement funds, go through probate when they don't have to. They're not meant to go through probate. Those sort of assets, you identify who's to get them, and they pass outside of probate. Once they go into probate, they're open to creditor claims. So your loved ones that you would have wanted and just forgot to put on there, they're at the bottom of the list. They're under American Express, they're under Emory Healthcare, so it's really important that you check. Child support.
Okay. We had a question that came in from our virtual audience from David Braithwaite, and it's kind of along these lines. How do I approach my mortgage company with the intention of putting my house into a trust? Can anybody answer that question?
All right, that's a great question. So with regards to placing your house in a trust, just to kind of give you an idea of what this is, we're taking the property out of your individual name and putting it in your family's name, or whatever the trust is, the Williams Family Trust name. Okay to do with your primary residence. You get a pass for that. As long as it's your primary residence, we can transfer it into a trust. If you're someone that has rental property or investment properties and there's a mortgage, you've got to be very careful about that. The only way that I'd feel comfortable as your estate planning attorney transferring that rental property into the name of the trust is if we get lender written approval. Okay, because what we don't want to do is there's a clause in your mortgage that calls the note if you make a transfer. Okay, we don't want to do that because most people are not in a position to pay tens or hundreds of thousands of dollars on the mortgage.
Great, thank you. Oh, we have another question from the audience.
So I would like to piggyback on that. So what if you get the trust and you want to put your home in there? Do you fund the trust, or would the person who is the Melton fund have to send all the paperwork and do all the funding?
Okay, so you're asking as an attorney, do we fund the trust?
Yes, do you fund it?
It depends on the attorney. So if you come to me, I assist with funding. So funding is another way of saying retitling assets in the name of the trust. So that the house that you have, that deed, we're going to retitle in the name of your family trust.
Okay.
Some attorneys do, some attorneys don't.
Okay.
Yeah, that's a great question because, as Anitra mentioned earlier, the trust is a structure, it's an instruction manual, but if you don't put anything in it, it's kind of irrelevant. So you have to fund the trust in some form or fashion to make it actually worthwhile.
I do want to add, as part of funding a trust, you can also do that with life insurance. And so when me and my husband did our trust, we took our life policies and we updated the beneficiary to the trust name. So upon passing, that's millions of dollars that will also fund your trust.
Okay. So we were talking just a moment ago about different ways that you can convey whatever assets you have, whether through a trust, through the probate process, whatever the case may be. And obviously, I think we all understand if you can avoid it, you want to avoid probate if at all possible. But understanding that there are different ways to do this, Anitra, can you explain why estate planning is still valuable, even if you were to do some of these other things?
Absolutely. So I'll say this. I get a question a lot of times by adult children that call, and they say, my parents are getting a little bit older. I think it will be on the safe side if they just add my name to their property. Okay. A couple things about that. We've got to get their permission so we can have this conversation, but ultimately it's your folks' decision on whether they want to add your name. I always say that's not a good idea to do it that way. The best way to transfer real property is at death, by way of a will or by way of a trust or a transfer on death deed coupled with the will. The reason is because there's three main reasons. Number one, putting your adult children on your property could open up a liability for yourself. If this adult daughter or son, they've got creditor issues, now you have creditor issues, now you have a potential lien on your property, which nobody wants, right? That's one. Number two, you've opened up yourself to tax liability, because essentially what you've done is you've given them an interest. That should be reported, and it could be a potential problem later down if it's not. The third reason why it's not the best way to transfer is because you lose the ability to lessen any capital gains if your adult son or daughter wants to turn around after you passed away and sell the house, okay? So they're gonna have to pay more in capital gains if you do it that way versus just do it at death with a transfer on death deed under limited circumstances or a trust.
Great. I'm going to say one other thing that she probably didn't want to say, but it's real. By putting your adult children or whoever it may be on there, there's also a control issue. And should that adult not do what's in your interest but in their interest, you've opened yourself up to that.
Yeah, so she said, can you designate that at trust? That is the way that you're gonna do it. You're either gonna wanna do it by way of a trust, will coupled with the transfer on death deed, but again, it's at your death. So the trust, once you pass away, we open that instruction manual and see, well, what did you want to do with the house? So that is completely acceptable.
Okay, so then, say for instance, you have a special need kid. Is there a special trust that you need for that individual?
Absolutely. So if you have a special needs child, there's a special type of trust that you need for them. Absolutely. A lot of people refer to it as a special needs trust. It's a supplemental needs trust. And the benefit of having this type of trust is that if you've got a special needs child who's receiving government benefits as a result of that, what we don't want is your inheritance to kick them off of those federal or state benefits. And that type of trust, the supplemental needs, sometimes referred to as a special needs trust, is the way to do that. We don't want to kick them off. We want to still let them have access to those funds and someone controlling those funds and still receiving their governmental benefits. That's very important.
Okay. Just to speak to what you were mentioning about capital gains in case anybody doesn't understand how that works. And again, this is not tax advice. However, the way the tax laws are currently, as I understand it, if you convey something to another person, so let's just use an example. Let's say you own a home that you purchased for $200,000. Today, the home is worth $400,000. You have incurred a $200,000 gain if you were to sell that property. Now, again, if it's your own residence that you live in, there's an exemption. You wouldn't owe any taxes on that. However, if you pass that to your child or whoever your beneficiary may be, then when they get it, now they start at $400,000 for the value. And if they were to immediately sell it, there is no capital gain that they would have to pay taxes on. Otherwise, they would. So hopefully that clarifies that issue of capital gains. Tax avoidance puts more money in your pocket. Any questions on that? If anybody has a question, just raise your hand. Okay. Okay, so the question, are you avoiding capital gains by transferring to your kids? Yes and no. What is happening is you are raising what is called the cost basis in the property to the inherited person. So if there was growth in the value while you were living, you would be responsible for it while you're living. But when you pass away and you give that to somebody else, they start at that new point. Did I explain that?
Yeah, it was perfect. And I just want to look at the other side, the uglier side. If you just place their name on the property, we're not starting at the $400,000. Now we're looking at that difference, that $200,000. So if you just place your adult child's name on there, you've got that $200,000 in capital gains that taxes have to be paid on that if they turn around and transfer it. Okay, so that's.
Exactly. Great point. All right, let's ask another real estate question for Dawn. In an environment like we're in today where interest rates are much higher than they have been, home prices are fairly elevated, can you explain why whether it's right now or any other time, why it's still valuable to invest in real estate?
It's always valuable to invest in real estate. I tell people that all the time, especially with the prices. If you live in Metro Atlanta, for example, the rental prices. The rental prices now are exceeding the purchasing prices. I have adult kids that are paying more in apartments than I am paying in a mortgage. And I had to let them see the value of that as well. When people ask me, it's gonna always increase. If you keep saying, I'm gonna wait for the market to go down, I'm gonna wait for the interest rates to go down, you'll be waiting forever. The good part about it is we're seeing a little shift now in the prices are dropping because the houses are sitting for a little longer. And so buyers now have that opportunity to wait it out and offer less, and people are selling. So I've helped a lot of clients recently, and people always say, well, I can't get anything for that market. That's very untrue. Now, I'm not sure out here in Marietta, but like in the area that I am in, we're closing on houses between $250,000 and $400,000 every day. I just had 2 closings at $300,000. You're looking at a mortgage payment at about $1,400. Some people are paying $2,000 in apartments, in rentals. And the renters, and I'm a property owner that can rent a house. I own a house and another home that if we were to rent it, we could rent it for top dollar, $2,500. I mean, people are paying that for trailer homes. I mean, it's just now financially to dump your money into anything, I would say to purchase. If you are in the position to purchase. Get your credit together, get your stuff in line, because at death, we can't will an apartment to our kids. We can't leave that. My mother-in-law unfortunately passed away unexpectedly 2 years ago, but she did leave everything in a will. My husband was the only child. She left everything. We did have to go through probate. We found out that situation, and we also hired Anisha to get our stuff into a trust now because we don't want our kids to have to go through that process. Luckily, it was smooth. Everything was in writing. But, for instance, she had a debt that we did have to pay off because once it go to probate, that's opened up. And she did have debt that she left behind that we had to take care of out of that. We took care of out of our pockets instead of it coming out of her home because they could have easily attached to the house and everything, and so we switched the names. But I tell everybody to purchase because you can leave that. That's an asset that you can leave to your family. Land, property that holds value. And luckily, my family was able, my grandfather bought 115 acres in Virginia years and years and years ago, and has gone down 3 generations that's still in our family. And because but we have to make sure you pay taxes on it. So, but it's something like that that can go on for years and years for kids that weren't even thought about are now appreciating that. That's something my grandfather purchased. So I will always say purchase. Go ahead, you had a question? Mm-hmm.
Please repeat that question if you would.
Oh, she said what property types are showing the most appreciation right in the markets? Are you saying like what type of homes? When I say property, I'm saying that's what I'm saying. To purchase a home, that's the same one in the same. That's what you're asking me? Yeah. I mean, it's one and the same. Like, I mean, for instance, I purchased my home in 2002. We bought it at 150. My neighborhood now is going for the high 4s. Like, my house value now is $480,000, and I'm not selling. I'm not moving. I'm not going anywhere. But you look at the longevity of it. It appreciates. Like he said too, we thought about it too. We should go ahead and pay the last little $70,000 off because we had the money. But it's like I'm at a beautiful rate, 3%. I'm not going anywhere else when I see what the rates are now and the prices. But if the longer you wait, the long, you know, it's gonna keep increasing. It's like purchase when you can. I would say whenever you can, just go ahead, pull the trigger, because you can always refinance when the interest rates go down. You can always refinance, get a lower payment, but I would say purchase anytime you can. Go ahead. Down payment assistance.
Yeah. The lenders are being very creative right now. And, you know, for some purchases, they may just use your income, not your tax, not your, you know, your 1040s and, you know, the traditional way of buying a home. I'll put it that way. You know, so but doing that, right, just using income, you know, it kind of reminds me of, you know, back in, you know, 2008 when people get in trouble that way, and that's right. So what's your opinion on that? You know, is it just economy driven? You know, that
My
people,
opinion, it's economy driven, but it's also to get people in. Selling, that's the bottom line. They're trying to get people to qualify for the homes. I don't originate loans. I'm not a loan officer. I was gonna say he probably could speak more on it. It's a person by person basis to kind of get them approved for it.
Yeah, that's true. You know, the more exotic types of loan products are really designed to give more people access to a mortgage. But just having access to something doesn't mean you should necessarily pull the trigger on it. You know, the more exotic the loan is, you know, it's buyer beware, right? And in terms of, you know, yes, we did have a mortgage crisis because of a lot of this, but that was not so much the buyer side. That was more of how banks managed those portfolios of higher risk loans, and they mixed them in with lower risk loans, and they totally botched that. You know, we have structures now that hopefully hopefully they won't do the same thing, and we won't have another banking crisis in the U.S. But for the person who buys the home and they're looking at an interest-only mortgage or a balloon note or stated income, you know, they're always going to pay a higher premium for that because they are a higher risk, right? And so, you know, working with someone, looking at going into that, you know, there's a lot of questions that you got to ask. Like, is this something that you really need to do now? Or should we wait to get our credit in a better position? Should we wait to have more savings so we can put the money down on a house and we don't have to take a more exotic loan? But that's an individual case-by-case basis. But people should beware of those products because they can get you if you don't understand your terms.
And I'll just add one other thing, just kind of general advice. Just because you can doesn't mean you should. So understand that when someone is looking at lending you money and they're qualifying you, they're telling you what they will give you. You have to look at what can I afford. You're going to factor in all the other things that they don't necessarily pay attention to because that's not as important to them. So look at those things and then make your decision, as he said, based on your personal circumstances. Yeah, and I think the point of what happened in 2008, hopefully not happening again, that happened because of greed. Greed isn't going anywhere. Those who were in that position, there were regulations passed that mitigated some of that. And as we know in this current administration, regulation is being put on a lower priority. So who knows what will happen again. The bottom line is you always have to look out for your own interests because everybody else isn't necessarily looking out for yours.
And I will say this, just so you get approved for a $600,000 home doesn't mean you should go out and purchase a $600,000 home if that's not what you need for your family, because on paper, somebody could look at it and say, oh, she makes X amount of dollars, this is what you qualify for. They may not know that you're taking care of your mother, your parents, where you like to vacation. They don't know your plans for your kids. They're not asking you that. They're only going by income base. So you still have to know personally what you can afford. So I tell my clients all the time, just because you come with the approval letter of X amount of dollars, we don't have to purchase a house at that price. What are you comfortable paying? And for the long run, because it's a 30-year loan that you'll be paying. And do you plan on working for the next 30 years? You got to factor in a lot of things. So just because they give it to you, and like they said, they will qualify you. And it's a lot of people getting qualified, not really at the rate personally I think they should be purchasing a home. So always keep that in consideration, what you want to pay for yourself too.
Hello, but anyway, in looking at long-term interest, my interest, what about leaving money to minor children? My son has a house and he's fine. My grandson doesn't have a house. So I'd rather my grandson get my house than my son. And you know, there are certain other things. So how do you handle those situations? Because I've been told, do not leave anything to minors because it's.
You've been told correctly. So a couple things on that. We don't want to leave a lot of money to minors because they're minors, you know, and what are they going to do with it? And also legally, they're not able to take more than a certain amount of money. So the best way to transfer assets to minors is going to be in trust, okay? You can transfer a house to a minor for their benefit in trust to be held until they're a certain age. But then that comes into, is this a mortgaged property? If so, who's going to pay the mortgage and how that's going to be paid? So we can look into some options that were already mentioned in terms of putting a life insurance into the trust, and that could either pay off the mortgage. But yeah, we can talk about, like, you know, strategies and things like that, but we definitely don't want to leave assets to minor children. So that's, minor children shouldn't be on your life insurance, okay? A lot of times people want to put them on there, not yet.
I did have a grandparent that left life insurance partial to her granddaughter, and we couldn't just hand her that check. That money is going to stay in an account that State Farm holds for them until she's 18, and we had to do paperwork where her mother is the guardian of the state. It's a lot of stuff, but she won't get the benefit of that money. The good thing, though, it is growing with interest in that account, so by the time she's 18, she'll probably even have money for college, you know, be able to pay off her college, so.
That's a good point too. So they're not gonna have access until they're 18. Another thing that can happen, someone can file for conservatorship over that minor and get access to those funds for their benefit, right? Why do that? It's a hassle. Just have a trust, or just don't put them as a beneficiary.
Think Britney Spears if you heard that nightmarish story. All right. We have a question from our online audience from Kenneth Reeves. He says, I have vehicles, life insurance, 401k, and saving. Will a trust be a good option?
Vehicles, life insurance, and savings. It depends on what your intentions are for the trust, right? So if we are leaving our assets to minor children, we definitely want to have a trust. If we're leaving our assets to children or adults with special needs, we definitely want to incorporate a trust. So yeah, that's just a blanket statement there. And if we are transferring over the federal estate exemption amount of 13.6, that's what it is now, we definitely want to have a trust. Okay.
Another question from the online, actually, no, that's from in the room, but she must have put it online. Anyway, what are some of the pros and cons of annuities, and which ones are safe?
All right, pros and cons of annuities. Pros of annuities, I'll start with those. And to say annuities, there's a lot of different types of annuities, okay? So I'm going to be very general here. Some annuities I would probably never recommend to a client. Some annuities I could see justification for. Typical pro of annuity is they offer a lifetime benefit, right, on retirement. So you have a guaranteed benefit for life that you'll never outlive your money, which is an issue when it comes to retirement planning, is making sure you don't outlive your money. So that's good. Many annuities do offer investment vehicles inside of them that I would say are decent investment vehicles. So I'm not talking about a fixed annuity, which I don't think is very decent, but there are annuities where you can invest in mutual funds and things like that, like you can in your IRAs and 401ks. So that's pretty good. The downside of an annuity, well, there's a couple of major downsides to an annuity. One is the expense. The annuities are written by insurance companies. The insurance company is guaranteeing you a lifetime benefit, so they're going to want a fee for that, right? So annuities are more expensive than if you just invested in a mutual fund portfolio that wasn't an annuity, like your own IRA or something like that. So it's a more expensive option. What that means for you long range is that your portfolio may likely underperform if you chose something else. It's not going to grow as fast, okay? Another drawback to an annuity is most annuities will have, if you need to get to your money in a certain period of time, they will charge you a penalty for that. Some as large as 8% or 9%, like in the first 8 to 10 years, typically annuities have a penalty if you want to access your funds. So your access to your money is also limited in an annuity. Now, I have many clients that have annuities that use it to supplement as part of their retirement, and most of the people who decide to do that are doing it because they like the security, the safety, knowing that that money is going to come in regardless of what happens in the stock market. So it is kind of a security blanket, but they do have an expense. And I think the real risk is that you don't necessarily see that expense unless you're really good at reading your statements. They do disclose them, but it's built into that program. So does that help? All right, great.
So the annuity is more expensive than like some of the other insurance, right? Like you could be paying, say, like if you're 50 years old and you decided that, oh, I'm going to retire in the next 15 years, and you get an annuity, and it could be like in the thousands of dollars, couldn't it? I mean, depending on the amount you want
Okay,
to
so
supplement your income.
right, so the annuity has an expense inside of the annuity. It's an expense charge, right, inside the annuity, and it's a percentage. Okay, so the amount that you pay is going to be really dependent on how much you have in there, because it's going to be a percentage of that, maybe 1.5% or 2% or whatever. I mean, all annuities have different expenses depending on the company and the type of annuity that you have. So yeah, looking at that in comparing to having your money in a mutual fund portfolio versus an annuity, let's say your expense ratio in the mutual fund portfolio outside of an annuity might be 0.8%, but inside the annuity might be 2.8% a year. So that's an internal cost to the annuity. That's not like a premium that you're paying, but that is a drag on your investment portfolio. Does that make sense? So you see that cost built in. Now, annuities do have a death benefit, right? Most annuities have a death benefit. They'll either have a guarantee of what you put in, or they'll have watermark guarantees of how much it grew to, but those could vary as well. And depending on the type of death benefit, oftentimes there will be another additional expense built into it for the death benefit.
And with that, you would need a medical exam, right?
No.
You won't need a medical
No,
exam?
not with an annuity, no.
Okay.
No.
All right, I'll chime in on this just a little bit as well. What I think you were describing primarily is variable annuities. I'll put it this way, there are annuities now that they call like investment-only annuities. There are some that are indexed annuities where you either eliminate or lessen the amount of potential loss. So there's all kinds of stuff out there. So again, you have to do your research or have somebody help you do that research to make sure that what you're investing in is actually working for you. Now, you will hear some that may say, well, this is a no-cost annuity. There is no such animal. There may not be any cost that you see to what Chris was saying. It's embedded in somewhere, but no offense, insurance companies are not in business to do charity. They are in business to make money. They're going to make money. The question is it going to give you what you need? So that's what you got to look at.
You stated that there's a death benefit to an annuity as well. If there's no beneficiary named, it also is subject to probate?
Not if there's a beneficiary name.
If there
An
isn't.
adult
Yeah.
beneficiary name, since we were talking about minors earlier, I should point that out. But if there's a beneficiary that can accept those assets, then no, it does not go through probate.
All right. Let's see. For Natalie, here's an interesting question. A lot of people these days are frustrated when they see the renewal of their, whether it's auto insurance, homeowners insurance, whatever the case may be. Can you share with us why those premiums may be going up, and what are some options to help make them more affordable?
So if you live in the metro Atlanta area, I'm pretty sure when you drive around, you see, and we're talking about auto insurance, you probably see 1 or 2 accidents per day. And so insurance is basically the law of large numbers. We are collecting money from many people to pay the losses of a few. But when there are not few and there are many losses, that drives up the rate and it impacts everyone. Now, in some cases, I know our State Farm in Georgia, this month we're going through what we call modernization. So just kind of giving y'all some free game. So typically with that modernization, rates will go down. So it's going to factor in different things, not only your driving record. Most people don't realize your credit is also a factor in insurance as well. Youthful drivers in the household can also impact your rates as well. So things to kind of offset that, I would say making sure you don't have accidents, tickets that impacts your rate. Taking a defensive driving course that also can, lessen your rate too. But with this modernization with State Farm, we're probably going to see a lot of our customers, including myself, rate go down. So, I mean, just really and truly, like, we have a lot of accidents, and like he said, insurance companies, they're not going to take a loss. I mean, State Farm does really kind of take a loss because we sell other things that kind of help buffer it. So, for example, Geico, for every dollar they collect, they're not going to spend no more than like 96 cents on a claim. With State Farm, we will take a little bit of a loss. For every dollar we collect, we probably spend $1.05 or $1.06 on a claim. When it starts to become more than that, then they take rate. So, but now we're seeing rates go down, and, like I said, with modernization in Georgia, we'll see rates even go down even more.
Just another kind of follow-up to that. Let's say your circumstances haven't drastically changed, but let's say you're driving a car now that is significantly older, and you had at one time full coverage on your vehicle. Doing something like changing your coverages, what might you consider doing in that regard?
So let me just say this, there is no such thing as full coverage. When you are building out a auto policy plan, in the state of Georgia, you are required to have liability, and that's minimum 25, 50, 25. That means if you were to get in an accident, the company would pay out, the insurance company would pay out no more than $25,000 for bodily injury per person, up to $50,000 per accident, and $25,000 for property damage. That is all you're required to have. When people say full coverage, I think they're also thinking about, okay, comp and collision, where if you do get in an accident or you don't get in an accident, there's vandalism, your car will be repaired. So sometimes your car is older and you may say, okay, I should be paying a lesser rate. But remember, there's so many other factors that is taken in consideration when they're rating you. Also, where you live, your zip code. If there is a lot of break-ins or robberies, in some areas we know that the rate's going to be higher than others. There's so many different factors. But if you want to keep your rate down, like I said, good credit, no accidents, no tickets, defensive driving courses. If your child is driving, you also want to make sure that, they are taking a defense. We have what you call a steer clear course as well. And then also with State Farm multi-lining, the more policies you have, the cheaper your rate is going to be as well.
Yep, good point. And I'll just share this from personal experience when it comes to like changing coverages. Understand the risk that you're incurring when you do that. So my car is a little older. I've decided to drop some of the coverages because, I mean, realistically, if I got in an accident and totaled my car, there is no way in the world they're going to pay for it. Unfortunately, I got in a small fender bender, and that meant it was all on me to fix it if I wanted to fix it. So you just have to understand you're taking on some of the risk yourself. That's basically what insurance is. It's a game of risk. How much are you willing to accept for yourself versus how much do you want the insurance company to take on? Okay, let's ask a question of Dawn. A lot of people who are retired or maybe late in their careers are starting to look at these 55-plus communities. What can you share about what people need to understand that's different from just buying a regular home versus a home in a community like that?
Like, what are the qualifications other than being 55?
Yeah, and I guess what other factors they need to take into account as far as like cost and services, things of that sort.
It's a little expensive, but it's more in line of similar to living in an adult community, like one of those senior citizen community housing. In Henry County, we have a couple of those 55 and up communities. It's beneficial to my clients who are looking for low maintenance as far as the HOA covers everything from garbage to lawn. I mean, it's nothing they're doing but paying that mortgage because they do everything. And then built in these communities now, you'll see a lot of these popping up. They're going to have availability to pharmacies, to drugstores, to grocery stores. Everything is within that community. So it's beneficial for the parents, and like I have an elderly parent who is looking into going into one of those communities, selling his home and going into one because it's low maintenance. Is basically everything is right there, and it's also in a golf course community, so he likes that. But you're going to pay for it. It's going to cost to live in those. So typically the prices are a little elevated than a typical just community. If he was going to a new construction or a resale home, he's going to pay a little bit more. Within the HOAs, the fees are all built in, but everything is under that one umbrella of the community. But it's costly, so he'll have to pay for that. But I do like them myself. If you can afford it, I would say do it. And then also you got to keep in mind too, some of those communities are very strict when they say kids. It's no grandparents, kids can stay more than a couple of days in these communities, and it's built into it's very strict regulations. Like you can't say, oh something happened to my child and I had to inherit my grandchild. They will not be able to stay there. They're real strict about these kids staying. They're strict about the summertime, the hours, the quietness. I mean, they're real strict. So you won't see outside little Johnny playing and riding his moped. You're not going to see that. They can't do that in these communities. So keep that in mind if you are one of those senior citizens that do have family, or if you have an adult child who may need to come stay with you and they have kids, they won't be allowed at all. They're very strict on that because the benefit, if I'm moving in that community and I want to be away and I want to be with adults, I don't want to be standing next to you with all your children, and you know what I mean. That is the benefit of it. So you got to keep that in mind, and they are very strict on those policies. I had a person. She decided not to do it because of all of the rules of how long her grandkids could spend consecutive days at the house, and they do watch that. Keep that in mind.
Thank you. We have another online question from David. Again, can property in the U.S. Virgin Islands be placed into a trust that I have established here in Georgia?
Absolutely. That's another benefit, the beauty of a trust. So if you've got property, your primary residence in Georgia, and you have a property in the U.S. Virgin Islands, Alabama, California, all of it can be placed in your Georgia trust. Now, your Georgia attorney may not be able to place all of those unless they're licensed in all those jurisdictions. So your Georgia attorney is going to collab with an attorney in those jurisdictions to get that placed in your Georgia trust. So absolutely.
Okay, great. Chris, question for you. Oh, I'm sorry, we have a question in the audience.
own like a timeshare, how does that work?
Yes. Right. Would you say so sorry? Well, so this is what because I do have clients that own timeshare, so I always ask them, what do you want to do with this? Is this something that you want to keep and you want to give to your children, or are you trying to get out of it? So if you're trying to get out of it, it's a non-starter. We can, go through the process of getting out of it, and then we could just deal with the assets that you have. If it's something that you want to keep, yes, it can be incorporated in the trust. We would have to review the timeshare agreement for the terms, but it is something that we can incorporate. Some people are paying just the maintenance fees on timeshares. Some people are actually paying the fees, the underlying fees for the timeshare. So it really depends upon what it is that you want to do with it.
Florida, whoever
Yes.
in Florida, okay.
Yes,
to
'cause-
get it into the trust.
Exactly. So if you bought the timeshare in Florida, we would be working with a Florida estate planning attorney, because remember, this is all deed work. We're transferring title. So we definitely would be working with someone in Florida to do that.
And I would assume the same would be true, and I don't know how U.S. Virgin Islands is different than a traditional state, but similar type of deal.
We would find a local attorney in that jurisdiction.
Okay. Any other follow-ups on that one? All right, for Chris, question for what sounds like a bit of a do-it-yourself investing person. Can you offer some resources like websites for learning how to trade stocks and for investing responsibly after age 45?
Well, the caveat was doing it yourself personally, which kind of takes me out of it. No, I will say, there are a lot of resources, educational resources out there when it comes to trading and investing, understanding how to trade, how to buy on margin, how to call puts, all these things that you can do when you're trading stocks for, I'm going to say for fun, okay, because this is a very high-risk game when you're buying and trading individual stocks. A lot of self-professed day traders, even the smartest ones out there, can have some very bad days, right? So for long-term retirement planning, this is not a category that I typically delve in or recommend. I don't have a whole lot to say about it. I don't even do it for myself, and this is what I do for my career, but I don't day trade. I don't like stress, and I'm not a big gambler. And I don't like to try to bet on what things are going to do tomorrow. I get that question a lot. What's the stock market going to do tomorrow? Believe me, if I knew that, y'all wouldn't see me. I would be at the Virgin Islands with my property, worried about a trust, right? So no, and truth is, nobody knows that unless they have some undisclosed insider information and they're breaking the law by trading on that. But most people, you don't know that. You don't know what stocks are going to do tomorrow or next week or next month or next year. But when it comes to retirement planning, we do have a pretty good idea. We have a pretty good take on 10-year tracks and 20-year tracks and 30-year tracks when it comes to markets as a whole, not individual stocks. So go out there. You can find information. The internet is full of information. No, I can't recommend any one place to go because there are just so many. And, I'm not going to endorse anybody out there that says this is how you should trade. There are a lot of people out there that will say, hey, give me money and I'll teach you how to make millions trading. I would avoid those people like the plague because there's nobody that can do that, really. They can't. So hopefully that was the best non-answer answer I could give.
Yeah, that's a tough one. I will throw out for this individual something to consider if you want to kind of dip your toe in the water with stocks. Consider joining an investment club because that's primarily what they do. It's a group of people. They pool their money together. Somebody, I think on a rotating basis, is responsible for doing the research and all that kind of thing. That will give you a good way to learn how to do this without having to risk all of your own money because you have other people in it with you. And maybe you learn some things from those other people and their research too. So that's something to think about. let's go to another estate planning question. What is a good approach to initiating estate planning when a spouse and a child do not want to have the conversation without creating friction? Very easy question.
All right, so family dynamics. I think that the best way to approach it when we have a spouse and a child that don't want to talk about it, you're just going to have to get over the hump. I mean, there's just no easy answer, particularly for that scenario, because we're talking about your spouse and your child don't want to talk about it. Maybe we can find out the reasons why most people don't want to talk about it. We're talking about our potential death. It's going to happen to everybody sitting here. It's just a matter of when. And so we don't like to talk about it, but I promise you that once you do it, you're going to feel so relieved that it's done and that your family doesn't have to worry about it. If that question were tweaked a little bit, and we're talking about our parents, so sometimes our parents that are older, they don't want to talk about it because they feel like if we talk about it, we're kind of speeding things up. Or if we talk about it, why do you want to talk about it? Are you trying to get my house? Or whatever the thing is. But I find that if it's our parents, if we do our own plan first and then go to our parents and say, look, this is what I did, take a look at it. That may soften it a little bit, at least the conversation, and eventually they may turn around and say, okay, I want to do this too, especially if you have an estate planning attorney that's willing to talk to them, just having a chat.
And I think that's also a good point. Sometimes if you're not comfortable being the one initiating the conversation with your family, bring in an outside objective party to just kind of facilitate the discussion. Back to another investment question. Can you invest after retirement without penalties?
Yes, you can invest. You can always invest. A great time to invest is today. Slightly less great time is tomorrow, right? So I encourage people to invest. Think about it. Save. I really, in my career, and I've done this a little while. Makes me feel old to think about, but I have still yet to meet the person that says, you know what, Chris, I saved too much money. I invested too soon, too early, I was too disciplined. I got all this problem because I have all this money, and I don't know what to do. I have not, but I hear all the time, I wish I coulda, shoulda, started sooner, things like that. As you get older, so penalty. There's no penalty for investing as you get older. There are penalties if you invest in retirement accounts and you want to cash them out younger, right? But as you get older, no penalties for that.
Good answer. And I'll just piggyback on that a little bit as far as people who maybe have been disciplined and put their money away and they're sitting in good position. One of the challenges can be if you have done that for so long, kind of changing the switch and saying, okay, now that I'm retired, let me actually enjoy this money. Because in your head, you're saying, save, preserve. But if you've done a good enough job, that was the point of doing it, right? So that you can enjoy yourself when you get to that place. So it's important that you understand the psychology of this and make sure that when you get to that place, if you are in that position, that you do the things that you really want to do, because as we all know, nothing is promised. Don't put it off because it may never happen. All right, let's go to, this isn't for anyone in particular, so anybody who wants to field it, feel free to do so if you can. Is it wise to take Social Security at an early age and invest it, or wait until older and receive more?
Well, let me know when you're going to pass away, and I can give you a solid answer on that. Okay, since we don't know that, let's talk about it. Social Security, if you put off and you wait till I think it's 72 now, you get an 8% raise every year on your Social Security benefit, so you get a step up. Okay. Over that period of time from 65, 67 to 72, you're saying, or 62, take it early, should I invest it? That's a really short window to try to beat the 8% step up. So I would say no. That's going to be tough to take an early Social Security, invest it, and try to beat the 8% guaranteed step up that Social Security gives you. Okay? Could you beat 8% in any given year? Sure. But would I bet that on a short 5-year period? No. I'll take an 8% guarantee over 5 years any day. Make sense? Okay.
And for anybody who's maybe is considering, like you say, you can take it as early as 62, there's also a hit on the other side of the coin too. If you take it early, you're going to get a discount on your benefit. So if you take it early for the purpose of getting the money in hand to invest, and you got to ensure that you can earn enough on that money to overcome what you're giving up in income. Other thing you want to think about if you're considering doing that, if you have a spouse, you're also reducing the benefit they would get if you pass away before they do. So these are all things that you have to consider when you're thinking about when do I pull the trigger on Social Security.
It's a narrow game you're playing if you're doing that. You're playing like a very narrow margin there, and yeah, it wouldn't be something I could recommend for that goal. You know, some people have to take early Social Security for other reasons, and you know that could be addressed. But if the question was clearly, should I take it early and could I invest it and try to game it to beat it, that's way too narrow to try to shoot.
Especially if you need the money. Yeah.
As you stated before, we're not guaranteed, life.
We aren't.
So what
no.
if you wait till you're 70 and then 1 month after you lose your life?
Yeah.
So I guess it's that individual's perspective of what they need.
Mm-hmm.
And if they take it at 62, but maybe they look into a gig type of job or something to kind of support it, or I don't know. Or
yeah, I mean, you take a big hit to
no.
take it early. You really do, and it's not a one-time big hit. It's the rest of your life big hit, and that's certainly something to weigh heavily when you think about when do you take Social Security, and again, there's a benefit to having an advisor that can sit with you, looking out for your best interests, knowing everything that's going on in your life, and helping you make. Those are big decisions. Those really are. It's kind of crazy they just let us make them. I mean, it is like you could just say, "Yeah, I'll do that," and you could be making a horrible decision, and they'll just let you do it. Kind of like the mortgages we were talking about earlier. That's a big decision. The kind of mortgage you get into is sort of crazy. They'll be like, "Yeah, I'll let you do that," But that's the way the world is. So these are things that should be weighed out for sure.
Yeah, just one thing you mentioned, if you took it at 62 and took a gig job, you can do that. There is what's called an earnings test with Social Security. So if you take it before what is considered your full retirement age and you make over a certain amount, they're going to take back some of your benefit instead of paying it all out to you. So you have to understand how much that gig job might pay you and how is that going to impact your benefit. Now, at the end of the day, if you make so much money that it may end up growing your benefit later, it may work out. But again, these are things that you probably should think through and talk through a little bit more fully. Right. Yeah, and I think, so she said, what if you have a rental property that's bringing in income? That's a little bit of a different situation because it is unearned or passive income, which is not subject to that earnings test. But the whole idea of all of it is you got to look at your personal circumstances and figure out based on what you know now, which, again, we don't know what the future holds, but based on what you know and what you think, what might be the best choice for you. The other thing that you want to think about, too, there is an opportunity for a do-over. You make a poor decision on Social Security, you have 1 year to reverse it. But let's say you started at 62, and then your business that you started is starting to boom, it's making more money than you thought it would. I don't really need that money anymore. You have a year to say, okay, I changed my mind. You have to pay all the money back that they paid you, and then they start the whole process over again, and then you can reapply at a later date, but you can only do that one time in your life. You get one mulligan. You have 1 year, up to 1 year. You got to pay all the money back that you received. They're not giving it to you for free. So. All right, Chris, another question, kind of in a general sense. What is a good vehicle to put money in to earn high interest for short-term goals?
Well, there are several vehicles out there. For a lot of my clients, we use money market accounts. They're basically cash accounts. You don't see values dropping. CDs are another vehicle that banks may offer. I personally don't. But I like money markets because a person has access to their money. They're very inexpensive to get into. You can get a better rate of return than you can get in a savings account. And typically, like when I set them up, they're separate from the bank. Okay, so this is important because, kind of setting aside what I would call an emergency fund can be tough. I mean, mentally it's tough. You're saving money, and then at the end of the month you got a little bit left over, so you want to find something to do with that, right? That may not, in fact, be an emergency, but it might be an emergency at that moment. And if you can have it separate, then it's kind of out of sight, out of mind, and you can really accumulate something. So yeah, money market accounts, and then really all you're looking at is a 2 to 3 day lag from transferring from your money market into your checking account when you do in fact have an emergency and need this money. But yeah, an emergency fund is a really big deal. This is probably the linchpin for most people, whether they do well financially or they don't do well financially. What I see is, do they have an emergency fund? Do they have money they could get to, because emergencies happen, and they're not inexpensive. We were talking about HVAC earlier, and I just had to replace a unit at my house, right? Yeah, those things are expensive and they don't last forever. It's the craziest thing, That was like an $8,000. Hey, surprise! You need are you going to do it without AC? No, we're not. So that's a big. So what are your options? If you don't have the emergency fund, then what are you doing? Well, you're financing it, and now welcome to debt, right? And so a big reason people have debt is lack of an emergency fund. Money markets are great, terrific ways to do that. If you do a money market through an investment company, they are not FDIC insured, just like any other investments that you have. But again, these are cash accounts, so they don't fluctuate with the stock market. They just grow. Okay.
And many people have heard the term high yield savings account. I think that's primarily what you're talking about. A lot of those are money market accounts. Typically, those are like with online institutions where there may or may not be a physical bank. That's where the time lag can come into play. But to Chris's point, it gives you access when you need it, unlike, for example, a CD where you might have to wait until the term expires to avoid any potential penalties or anything like that. All right, let's see. Let's move to another. It's probably an estate planning related question, but again, anyone can chime in if you feel so led. If you receive money in a settlement, are taxes deducted?
Okay, so for an auto accident settlement or something like that, any sort of settlement. So I'm not a tax expert, so I can't speak I don't like to talk about taxes. So I honestly, that's not a good question for me. So if anybody else on the panel is familiar.
I think, and again, I'm not a tax expert either. It probably depends on the way the money came to you. Settlement, like a car situation, like if you got hit by a truck or what have you. As far as I know, you're not subject to tax on that. You have
I would say typically no, because most settlements, the idea is they're making you whole. So you've suffered a loss and now you're made whole, meaning you're not profiting off of this. There's been no gain to you. You know, you pay taxes on gains. You don't pay taxes on being made whole. So like if you were in a car accident and had State Farm insurance and you got your car paid off, you've now been made whole. It's not a taxable event. But I am not a tax advisor, so I cannot give tax advice.
And if you want to chime in on this, Natalie, feel free, but kind of a related issue, if you receive life insurance proceeds, the tax implications of that is?
That's a good question. It is federally tax-free. It depends on what state taxes it may be, depends on whether you're taxed or not, but it is federally income tax-free.
And that is with almost every life insurance policy. There are some, to what Natalie has spoken about earlier, permanent life insurance policies where people are using that as a wealth building vehicle. They can create what is called a modified endowment contract, which makes it lose that tax-free death benefit. Most people are not in a position to do that, so chances are you don't really have to worry about it, but it is out there if you find yourself in that position. We have a question.
And speaking of that too, State Farm, when we do policies, they make sure, they'll alert you like, hey, this is a potential, they call it MEG situation. So that's something we do watch out for customers so they are not in a taxable situation.
What about inheritance? You mentioned land in Virginia. If you guys were to sell that property, would you have to pay the state of Virginia or the state of Georgia as if you're that resident? How would that work?
I will say this, we do pay state taxes on the land, just like property taxes. We have to pay yearly property taxes on the land. Land is paid in full, but we are required to pay the taxes on that land. Now, if you sell it, same thing. If you sell it, but we pay to the state of Virginia in that county. It's a county tax. We do pay yearly taxes on it. And you gotta be careful about that too. If you inherited land, we went a couple of years without knowing that it was behind in taxes. And they alert the people in Virginia, these taxes are not being paid. Anybody could have paid those taxes and we would have lost it. So we have a group that monitors and collects and pays that and make sure we keep those taxes paid. So if you sell it, the proceeds of it, or is it taxable?
That's a good question.
Okay.
So it goes back to what we were talking about with the capital gains. Two questions. How are you transferring the property? Are you transferring at death, number one? And what's the value that you're transferring over to the beneficiaries? So if the value that you're transferring over, and I'm just gonna speak to the state of Georgia because we don't have a state estate tax. There's a federal estate tax, and right now that's 13.6 million, maybe a little bit more with inflation. But we've got to know how are we transferring it, number one, okay? Are we transferring it at death? And number two, what's the value that we're transferring? And if we're in another state that has an estate tax amount, it's gonna be lower than 13.6. So there are some states out there that have a 5 million, a 1 million. So now we might be looking at some taxes on that end. So we just have to answer those questions.
Yeah, so different taxes for different things. Everybody's got their hand out. All right. We maybe alluded to this a little bit earlier, but another estate plan related question. What practices are best to transfer wealth to children?
It's going to be a trust. Minor children, it's going to be a trust. And that's because a trust gives you the flexibility to transfer assets over time. So if you've got minor children, whether your own, your nieces, nephews, grandchildren, you can actually indicate in the trust, okay, I want you to receive 2 distributions, one when you're 25 and one the rest of it when you're 35, okay? And the beauty of a trust is that if that child needs something between those ages, we can even build in discretionary distributions, meaning as long as that need has to do with their health, their education, their maintenance, or their support, the successor trustee that you leave behind to make these decisions, because remember, you're gone, it's within their discretion to give it to them. So the best vehicle for children is always going to be a trust, whether you do a standalone trust, that revocable living trust, Or you can have a will with a testamentary trust, but it's going to be a trust if you're dealing with minor children.
Great. You spoke.
And I'm sorry, one other thing. I just thought about adult children that you may have concerns about adult children, so you may have an adult child that has an addiction problem, whether it's drugs, gambling, any of that, alcohol, and you fear that you giving them an outright inheritance, they're just going to squander it. You can do the same for adults as well.
Yeah, very good point.
Yes, that's a good question. So the question is, should you have a will and a trust? And the answer is yes. If you have a trust-based plan, you're going to want to have a will. Potentially for two reasons. If you have minor children, the will is the only place that you can designate guardians for that child. So God forbid something happened to you and something happening to the other parent. We want to know who would you have wanted to raise your child, okay? And that's going to weigh heavily in that situation. The other reason why we do a will if you have a trust-based plan is because you may later acquire property in your name only. And as an estate planning attorney, we check in every 2 years, but we're not there daily with you to know everything. So if you purchase a property in your name only and then you subsequently pass away without an opportunity to transfer it into the trust, that property in your name only is going to have to go through probate. And I would not send clients to probate without a will. So it's backup.
Yep. The will becomes the catch-all for situations like that, as well as for stuff that you don't want to specifically designate putting in the trust. You might have some china that you want to leave for your grandchild. You want to put that in the trust. You can do that through the will because it's picked up by anything you don't designate. You were talking about small children preparing for their education, et cetera. Chris, can you explain the types of accounts you can set up for specifically college education?
Probably the most popular type of account for college education savings is what's called a 529 plan. Every state has a 529 plan that you can invest in. All states' plans are a little bit different. They're not all the same. You can save in another state's 529 plan for your kids in college. I actually do that for mine. I'm not in this state's plan. I'm in another state's plan. But 529 plans are great because your contributions can be tax deductible. They grow tax-free. You're not paying 1099s every year. And when you take the money out, so long as they're used to pay for qualified education expenses, they come out tax-free. So there's a huge tax benefit to saving in a 529 plan. There's also another type of account that's been around for a long time. It's called a Coverdell Education Savings Account. These are much less popular now because 529 plans offer so much higher contribution amounts that you can put into each and every year. Again, if you are interested in looking at 529 plans, I do recommend that you talk to an advisor because that's really the only way that you're going to be able to get a full view of all the kinds of plans that are out there. It would be tough to shop them all to see which one might suit you the best. But many 529 plans work much like a 401k plan would, where you have choices of mutual funds that you can invest in. They even have target date funds for, if you have a target date for when your child will get to school, they have a target date fund, that you can choose in there to set up for that.
And just on the point of the deducting the contributions, that's where the state affiliation comes in. So if you are contributing to your own state's plan, you can deduct the contribution up to a limit on an annual basis. But if you're contributing to an external state's plan, you cannot. But you still get the deferral on any growth in the investment, as well as tax-free distributions, again, assuming they're used for qualified educational expenses.
Do you get the tax benefit if it's for a niece or nephew and you're not the actual parent?
Yes.
Yeah, my understanding, you can go as far out as like a cousin. There has to be some blood relation, but I think you can go as far as a cousin. I don't even know if it probably doesn't even have to be a first cousin. I'm not sure. But yeah, you could do it. You could certainly do it for a niece or nephew.
Again, I'm not a tax advisor.
Right.
They are pretty loose with
Yeah.
The other thing I'll add about 529 plans is you can change, you can move the money. So like if you have multiple kids and one child decides they don't want to go to college at all, you can shift the funds that you have that had saved for them into your other children's accounts, which is very helpful and beneficial.
That brings up another valuable point when it comes to these types of plans. So let's say you started this plan for your child when they were 5 years old. You've been putting money away year after year after year, and they decide, nah, I'm not going to college. Oh, no. Well, again, that's one option. If you have other children, nieces, nephews, grandchildren, cousins, what have you, you can change the beneficiary. The other thing that came into place, I guess about 5 years ago now, if you have saved for that particular child or beneficiary and they're not going to use it, you can convert that into their own Roth IRA account up to $35,000 maximum, and you have to have had the account for 15 years. If those two things are in place, then you can basically start their retirement account for them. Okay, let's go to a life insurance question. So, Natalie, I'm sure if you watch TV at all, you see these commercials for, oh, you can get life insurance for $5 a month with no health questions. I think it's $10 a month, but anyway. Talk to us about what you have to pay attention to and look out for with those types of scenarios.
That's a good question. A lot of times with those policies, they have clauses on them. So if you pass away within 2 years, sometimes they won't pay out. Or if you pass away from something that's non-accidental, they won't pay out. So there's a lot of little clauses with those. We also have policies like that where it's a guaranteed final expense where there's no underwriting, but we have to tell you if there is a death that is not as a result of an accident, meaning like a motorcycle accident or a car accident. If it's like a death from natural causes, within 2 years, we just send the premiums back to the beneficiary. Some people want to do that because they don't want to go through underwriting, or they know if they go through underwriting, they won't. Yes, but if someone has called me, their husband was in hospice, I'm like, we're not even writing this policy. I don't want to take your money from that. But if you want to I tell people, go through the process of getting underwriting to get the right amount that you need for life insurance. I will also say this, look at also getting life insurance on your children while they're younger, because after 15 days, you can get a policy on a child. But as what I'm seeing, especially within the last couple of years, past COVID, people are getting life insurance and they're either getting declined due to health issues, or they're getting table rated, meaning they're not paying the standard rate because maybe they have diabetes or high blood pressure. I'm seeing a lot of that. Most people don't also realize if they're also factoring like mental health as well in insurance. And also most people don't know this too. If you've had multiple bankruptcies, in some cases you may not be eligible for insurance. So I would say don't put it off. You want to get it as soon as you can, get as much as you can while you can, and especially get those kids insured. Grandparents do it all the time for their grandkids as well. We call it a gift of life. Get those kids insured so they could, if they do get older and then they develop some kind of condition that makes them uninsurable, they already have something in place.
Along those lines, you mentioned, you pick an amount. Talk about what you should evaluate to determine what is the amount of insurance that is appropriate.
I think I mentioned this earlier. I talked about it kind of quickly, but we use an acronym called LIFE. So when I meet with a person, we do a life needs analysis, and we start off with loans. Well, if you were to pass away today, how much in loans would you want to pay off? And that is going to be maybe your mortgages, car loans, credit cards. Student loans are kind of iffy, up in air, but some people got their loans forgiven, some haven't. It depends on who signed for it. you also mentioned earlier, if you don't have a will or a trust in place, or you can go to probate, things that you own could then eat away the assets that are supposed to go to your family. Then we have income replacement. This is probably going to be your biggest number in terms of life insurance. If the breadwinner passes away, we still got bills to pay. We need life insurance to income. So some people do, either 5 or 10 times or even up to 20 times their annual income of that person. That's probably going to be your largest number if someone depends on you financially. And then the next will be final expenses. Some people want to be cremated, which will be obviously less costly, but that still is a cost. Obituaries even cost as well. That's not even free. Or some people want these grandiose funerals. It depends, and you can spell that out in the trust and how you want to, how you want that to go. But final expenses also covered. Income taxes is also part of those final expenses. Even when you pass away, a tax return is still due for you at the end of the year. And then education expenses. So if there isn't a 529 in place, or you want to make sure XYZ child goes to college upon a premature death, that also factors in. So we typically do, we come up with our number, and then we explain the different types to the customer. So sometimes people, they don't get all term, or they don't get all permanent. They may even do a mix of two depending on their needs or their wishes. And then one of the things that we also do is every year we check for beneficiaries. I'm going to call you and say, hey, let's do a review on your policies. We have paid out ex-wives before, and it was not pretty. And one lady happened to be in a courthouse ready to get married to her other husband and is calling about the beneficiary, her check from her previous husband that passed away. But she said, I still got kids I got to take care of, right? So I'm just like, but truthfully speaking, that particular person was going through some mental issues, and we could never meet with them. But the beneficiary review is very, very important. Also making sure, especially if you have a term policy, that needs to be evaluated, right? Because then at the end of the term, it typically would go up if you decide to keep that term. So sometimes we either give you a new term or look at doing a term conversion to a permanent policy. Because when is life insurance important? When you pass away. If your term runs out and you still have a need for life insurance and you are not able to get it, then we haven't done what we were supposed to do. We want to make sure that is one claim that you will have to file, and we want to make sure there's coverage in place for that. You may not file a homeowner's claim or get into a car accident, but we know that one day our time is going to be called, and we want to make sure that transition is smooth for not just our families, especially, like funding your trust, making sure that, there is money to pay for those things that you want to leave for your family.
Great.
Oh, and I'm going to say this. I'm going to a financial conference this week. One of the things that a year ago at the conference, they were saying that African Americans, our net worth is the same as it is in 1865. If 1 in 4 families got life insurance, we will close that wealth gap. 1 in 4. And it's going to be the cheapest way for us to transfer wealth to our family. The cheapest way. So for 2 cents on a dollar, or 2 cents on a dollar, you can transfer life insurance to your family, federal income tax free.
Great point. Oh, we have a question?
I was able to purchase a number of savings bonds through payroll deduction. And so, some of them are coming up to the time now. So what do you do with those? Just keep them indefinitely? Because I made a mistake and tried to deposit one, and my banker was, oh, no, I don't think you want to.
Well, that depends. That really depends on what your goal is with that money and what you want it to do. Savings bonds are nice to have. You're probably not going to get the kind of return on a savings bonds that you could potentially get if you invested it, in another place. But again, having savings, I never say, hey, don't have savings. I think having savings is great. But it really depends on what the goal is with that money. Like, what in your total financial picture, what is that money doing for you? Is that part of an emergency fund, a fallback strategy, or is this money that you would rather see grow? you know, and you have to really evaluate that. When you look at your whole plan, it's like, what am I doing with my money, and what is this money doing for me? I find a lot of times people have money sitting in cash, which, I kind of call a savings bond like cash. I mean, it's just sitting there. You know, it may make a little bit of money, but it's really not doing anything other than just being there. And again, having an emergency fund is important, and you do want to be sure you're getting some kind of yield, like we talked about a money market or high yield savings before. But again, also, if we don't have retirement savings, if we don't have money growing for us, and this money's not working for us, it's probably not doing the thing it's supposed to do, right? So there's a category for everything. It just depends on what category that's serving for you. If that's part of a retirement strategy, then you might want to look at a better yield. That's what I'm saying, yeah.
Okay, one last question, and we'll do just a quick wrap up if anyone has final comments. So we talked a lot about estate planning from a death perspective, but can you talk about the importance of estate planning when it comes to incapacity?
All right, so estate planning is two main components. It's the death component, which most people think about, and it's also the incapacity component. So as we're sitting here today, it is very critical that you have what's called a healthcare directive. Healthcare directive has two pieces of it. One is if you ever, God forbid, find yourself incapacitated, easiest example is a coma, you're gonna want someone to make healthcare decisions for you. Who is that person? Who's the backup to that person? Who's the backup to the backup, okay? Because you never know when you'll need it. That's number one. The other part of a healthcare directive is a little bit more tragic. It includes provisions as if you find yourself in a vegetative state, what's the treatment level that you want? Do you want the doctors to do everything that they can? Do you want all the medications, hooked up to all the machines, having everything? Or are you someone who says, no, I just want a natural death to occur. I just want to be comfortable, give me pain medication. All of that is outlined in this document. And it's very, very important because we just never know when it will be needed. And you don't want to find yourself in a situation when you have the document and you have your spouse there. Because remember, you're not communicating. That's why we have to even look at this. You've got your spouse on one side saying something, and you got your mom on the other side saying the other thing. The doctors are not going to know who to listen to. So it's very likely that they may say, you know what? Go and get guardianship. Go and get temporary guardianship. Emergency. It still takes time. In these situations, time may be of the essence. So it's critical.
Good point. And the other piece that's important about what you just said is communicate what you have to the people who are authorized to make these decisions so they know what's in place, what their authority is to do certain things, and where to go get the document when they need it.
Yeah, because the people that you identify as your agents, the people that step in your shoes to make these decisions, this is heavy, heavy lifting for them. It helps them if they know what you would have wanted.
And then the non-healthcare related stuff.
The non-healthcare, so now we're talking about a durable power of attorney. Same type of thing, someone is stepping in your shoes to make decisions, but these are financial decisions. Decisions having to do with your property potentially, or bank account, banking, that's probably the most common one. And for the durable power of attorney, it could be that you're incapacitated in that coma, or it could be you're on vacation in California and you need someone to go into that Georgia-owns credit union to transact something for you. So it could be incapacity or out of convenience.
Great, okay. Oh.
Yes. So those documents, those healthcare directive and the durable power of attorney, they do expire at death. And at that point now we're either looking at your trust or your will to determine what your wishes are. Very good point.
All right. We're going to start closing up. So if we can start with Chris and work our way down with any final comments you may have.
I guess my biggest comment would be, don't shy away from sitting with someone to talk about these things. One thing in my career, I find people say, well, I want to talk to you when I have when I get everything together. I really want to get to a better place, and then I want to sit down and talk to you. And that's similar to telling a doctor, when I'm healthy, I'll deal with you. But while I'm sick, I just need to, And you would never do that, right? And believe me, if you sit down with a financial advisor that's worked more than 2 months, they've probably already seen it. There's nothing to be embarrassed about with a financial situation. Most advisors will talk to you, for anything. I know very few. Now, there are some that say, hey, you have to have X number of dollars to get my attention, but that's not me. I talk to anybody. I think that's why Kevin has me out here. It's like I'm always happy to talk. I never mind answering questions and helping folks out. So take advantage of that. Don't try to do things on your own when you have help out there for you. I get the question otherwise. Well, so say, Chris, I don't want to work with you, but I want to look for an advisor. What should I look for? And I would tell you, talk to a few and find out someone that you were comfortable with. That's like the biggest thing. It's not the company that they're brokering through. Sometimes there's been a trend to say, hey, fee-only advisors are better than commission-paid advisors. I happen to get paid both ways, and I would say that's not necessarily true. The only people that tell you that are the fee-only guys. I mean, they're the ones telling you that, so of course they're the good guys and the other guys are the bad guys. But I think it really boils down to your comfort level with an individual, and working with, are they responsive to you? Will they return your phone calls? Do they make time for you? Do they have a sincere interest? And sometimes you have to shop around a little bit for that. As you do any professional, whether it be an attorney or a real estate agent or an insurance agent, I always recommend shopping around and finding somebody you feel truly comfortable with, because, the clients I've had for 20 plus years. These are people that I know more about than their kids know. When it comes to their personal finances, no one knows some of the things I know, so I better be someone trustworthy. Does that make sense? And so this is a serious decision who you work with, but don't put off working with somebody. Don't wait. All right, that's it.
Okay. Yeah. So what I would say is the best time to replace the roof is when the sun is shining. Okay? I can't tell you how many calls that I get from adult children that want to have their parents have an estate plan. And so I ask them questions, and then I find out that their parent lacks the capacity to do it. So it can come a time where it's too late. So while you're sitting here and you have the capacity, you're in your right mind to make the decisions, because there are many decisions that need to be made, this is the time to do it, or at least have a conversation with a professional that can give you your options and you can weigh them.
Both of them said exactly what I was going to say. 100% of my clients that I work with are referral basis. I don't advertise. I don't go out. I meet a lot of people doing seminars. I meet a lot of people just because they handed my information off. I say that because find you somebody that you trust that's going to look out for your best interest, not just looking out to making a commission on selling a high-end home. I have people that I will refer out because I know that they're not going to listen to me, because I'm the type of person that I'm looking out for your best interest. I'm like, do you really need all of those bathrooms? Do you really need the granite countertop? I'm the devil on the shoulder in a place like, oh, girl, that's too much, and I am that person because I would want somebody to look out my mother like that. I would want somebody to look after my aunt or myself or my sister. I don't want anybody to ever take advantage of it because I am a homeowner, and I know, just like you said, cost going to come up right now as we speak because my phone is buzzing. I'm getting my HVAC put in. Those things come up. At this moment right now, it's like your hot water tank can go out. Your air conditioner can go out. I had to get my septic tank dug up and found out it was an extra $5,000 because a root had went through and busted the pipes. Things are going to come up, and you just can't have it in your mind, oh, I'm going to pay a $2,000 mortgage. No, it's a lot to home ownership. But I would say find you somebody that cares about you, that will walk it through you. Don't wait. If you are renting, just look into it. It doesn't hurt to have a person who can pull your credit or to tell you, a financial advisor, this is what you can afford, and walk you through the process. And then you call somebody like me that'll walk out and find you exactly what you need, because I will do it high and low. I'm up all night. I get a joy out of helping families leave that type of thing to your kids. You would want to leave a property it's very, very rewarding. I mean, to be able to sit in that position where now what they do with my house when I'm gone, my 4 kids, I tell them, let them fight over it. I don't care, it'll be paid for. They can sit on it, they can sit in the back and do whatever, but I will feel comfortable knowing that I'm leaving that for them. So,
Thank you. As I hear everybody talk about home ownership and assets and all that, I realize insurance really is the foundation of all that, because we're helping you to protect your assets. We're helping you to protect your income. We're helping you to protect the transfer of that to your beneficiaries or the next generation. As I said, definitely work with someone you can trust. I hate to say this, sometimes I feel like this is Scamlanta. So, you know, sometimes people are very leery, you know, about who to do business with, but you definitely have to find someone that you are comfortable with, that is knowledgeable, that is integrous, and that you trust, and that can help you navigate. As I said with life insurance, don't put it off. If you got little ones, please make sure you get them insured. Anything could happen. Anything could happen, God forbid. And another thing I didn't mention is that I would say, typically they would say 50 and up, but I even venture to say about 45. Long-term care coverage insurance is very, very important. So if you haven't looked into that, please do. My website is www.insurewithnat.com, or my car is, I just got my car wrapped after almost 10 years. So I'm so excited about driving around with my information out there. But we do business in all over Georgia, but based in Marietta, and we actually also do business in Tennessee, South Carolina, and Alabama as well. I really want to see our people move forward and just put ourselves in a better financial situation. So if you have any questions, please don't hesitate to ask me. I would love to connect with you and help you in any way I can. Thank you for having us.
Thank you to all of our panelists. Please give them a round of applause. I will mention, I forgot to do so earlier, Natalie and Anitra were sponsors for our conference back in March. And on your note sheet, their contact information is located at the top, so if you want to reach out to them at a later time, feel free to do so. I can't speak for them, but if they can stick around a little bit after we're done, if anyone has personal questions, they may be able to kind of talk some of that through with you. But thank you so much for sharing your knowledge with us. We greatly appreciate it. Before we wrap up, I do want to make a couple of quick announcements. For those of you who heard about the Vision Board Workshop, we apologize for kind of horning in on some of their time. They started at 11 today. This workshop was originally scheduled for last week, but then there was a menopause-related event or events last week. So we moved it to stay away from that, not realizing that the Vision Board Workshop was going on. However, I did find out from Tawana Woods, who is one of the leaders of the Dreamlifters Ministry, that they're going to be doing Vision Board workshops, I think every month over the coming months. So if you missed today, but you still want to engage in that, you will have further opportunities to do so. Next announcement is our next event is coming up on August 19th. It will be webinar only. It is one of our panelists from the conference in March, Renisha Davis, who is a CPA, and she's going to be talking about making the transition from being an employee to being a business owner. So what are the things you need to make sure that you are taken care of if you want to make that transition? And then based on a lot of what we talked about today, I did want to just throw this out, even though it's well ahead of time. On October 11th, we're going to be hosting, in conjunction with the Married Couples Ministry, a workshop that will help couples to have that communication about all of their stuff. So typically, one person does all the stuff, the other person doesn't, and they may not know what's going on. So this will help them to understand how they can organize and share the information in such a way that everybody's informed about what's going on. So mark those items on your calendar if you would. There will be more communication coming out in the very near future. So again, thank you all for coming. For those of you who are out in virtual land, thank you for participating as well and sending in your questions. And with that, we will close it out for today. And again, thank you. Hope we will see you again very soon.